Yesterday, the S&P 500 closed at 7,736, an all-time record high, confetti on trading floors. Record closes for the Dow and Nasdaq simultaneously. Treasury Secretary Scott Bessent announced the US and Iran are very close to a Hormuz deal, strong tech earnings, falling rate hike expectations. By every short-term market metric, yesterday was a perfect day. On the same day, North Korea deployed a missile unit to Russia's Voronezh region, roughly 15 kilometers from the Ukrainian front. A nuclear-armed state, for the first time since the Cold War, is providing active military support, including weapon systems, to a nation fighting a European land war. The implications for NATO, for the global security architecture, and for the assumptions underlying 22 videos of this series are significant. Markets priced the S&P record. Markets did not meaningfully price the North Korean deployment. History has seen this before many times, and what history records about the moments when markets hit all-time highs while geopolitical threat quietly expands in the background is not reassuring for anyone who thinks the market's record-setting close settles the question of what is actually happening. The stock market is, in the short term, the world's most efficient pricing mechanism for the information that investors are currently paying attention to. Yesterday, investors were paying attention to earnings, to the Iran deal optimism, to the rate hike probability declining. The S&P 500 correctly priced all of these inputs at 76.36. What markets are structurally poor at pricing is the information that investors are not paying attention to. The slow building, structurally significant risks that do not fit neatly into the quarterly earnings cycle, the rate decision calendar, or the geopolitical news narrative that financial media has established as the relevant frame. North Korea deploying a missile unit to Voronezh does not have an obvious, direct, near-term earnings implication for S&P 500 companies. It does not change the Federal Reserve's rate path in the next 90 days. It does not affect the Iran ceasefire negotiations that are driving oil price optimism. In the short-term pricing framework that drives daily market moves, it is noise rather than signal. But in the longer-term structural framework, the framework this series has been building for 22 videos, it is a significant escalation of exactly the kind of multi-front geopolitical complexity that Dalios framework, that Jamie Dimon's warning, that the bond market's verdict at 5.2% on the 30-year have all been identifying as the primary source of structural risk to the financial assumptions underlying current asset prices. The gap between short-term market efficiency and long-term structural risk pricing is not a new phenomenon. It is the defining characteristic of every major pre-crisis market peak in modern financial history. The historical episode that most precisely parallels the current combination of record markets and expanding geopolitical threat is the American stock market of 1936 and 1937. The US economy had recovered substantially from the depths of the Great Depression by 1936. The New Deal's fiscal stimulus, the recovery in industrial production, and the improving labor market had restored confidence. The Dow Jones Industrial Average rose strongly through 1936 and by early 1937 was approaching its 1939 pre-crash levels, a recovery that markets and commentators celebrated as confirmation that the Depression era was finally ending. At the same time, the geopolitical landscape of 1936 and 1937 was assembling the preconditions for the most catastrophic conflict in human history. Hitler had remilitarized the Rhineland in March 1936 in direct violation of the Versailles Treaty, and the Western powers had done nothing. The Spanish Civil War began in July 1936, providing Germany and Italy with a testing ground for new military technologies and a demonstration of Western unwillingness to respond to fascist expansion. Japan invaded China in July 1937, beginning a Pacific conflict whose connection to the European crisis would become apparent 4 years later. American markets focused on domestic recovery priced the domestic improvement while systematically underpricing the geopolitical escalation occurring simultaneously in Europe and Asia. The prevailing narrative that American isolationism would insulate the US economy from European instability, that Hitler was a European problem rather than a global one, that the Pacific conflict was a regional dispute rather than the opening move of a world war justified the market's focus on domestic fundamentals. The Dow peaked in March 1967. By March 1967, it had fallen nearly 50% in the recession of 1967 to 1967, all 1967 to 1967 to 1967 to 1967, a collapse that combined the domestic monetary policy error of premature fiscal contraction with the deteriorating geopolitical environment that had been building throughout the record-setting period. The geopolitical risk that markets had priced at zero in 1936 ultimately expressed itself in both the 1937 to 1938 domestic recession and more comprehensively in the economic transformation of the 1936 that the war produced. The second historical parallel that most directly maps onto the current moment is October 9, 2007, the date on which the S&P 500 hit its pre-financial crisis all-time high of 1055. By October 2057, the subprime mortgage market had been in visible distress for months. Bear Stearns had disclosed in June 2007 that two of its hedge funds invested in subprime mortgage securities had lost essentially all of their value. BNP Paribas had suspended redemptions from three investment funds in August 2007, citing its inability to value their subprime mortgage holdings, triggering the first significant liquidity intervention by the European Central Bank. The Federal Reserve had cut rates in September 2007, explicitly acknowledging that the housing market stress was becoming a broader financial stability concern, and yet the S&P 500 hit its all-time high in October 2007. Despite the visible subprime distress, despite the Bear Stearns fund failures, despite the BNP Paribas redemption suspension, despite the Fed's acknowledgement that something was wrong. The market hit its record because the short-term pricing mechanism was responding to strong corporate earnings, particularly from the financial sector, which had not yet taken the write-downs that would later reveal the full scale of its subprime exposure, to a Fed that had just cut rates, and to a narrative that the subprime problems were contained and would not spread to the broader economy. The structural fragility that would produce the 2008 financial crisis was already fully in place in October 2007. The all-time high did not represent the market's assessment that everything was fine. It represented the market's inability to price a structural risk that had not yet expressed itself in the quarterly earnings cycle that drove its day-to-day movements. The current S&P 500 at 7,736 is not necessarily the equivalent of the October 2007 high, but the structural conditions, the bond market stress, the fiscal fragility, the geopolitical escalation, the statistical data questions are present in a way that October 2007 subprime stress was present, visible to careful structural analysis, priced at zero by the short-term market mechanism. The North Korean missile unit deployment to Russia's Voronezh region deserves careful analysis as a structural development rather than merely a headline. For the first time since the end of the Cold War, a nuclear-armed state outside the NATO-Russia conflict is providing active, on-the-ground military support to one side of a European war. This is not North Korea selling artillery shells to Russia, a development that has been occurring for over a year. It is North Korea deploying operational military units to Russian territory, providing direct integration of North Korean military capability into the Russian war effort. The strategic implications extend well beyond the immediate tactical situation in Ukraine. North Korea's active participation in a European conflict alongside Russia creates a precedent and a template for the kind of multipolar military alignment that the broader geopolitical framework this series has documented is assembling. If North Korea deploys military units to support Russia, the Chinese observation of that deployment, the Taiwanese observation, the South Korean and Japanese observation, and the American assessment of what it implies for the Asian security architecture all shift simultaneously. The Voronezh deployment also creates a specific and direct risk to the assumptions underlying the Iran deal optimism that drove yesterday's S&P 500 record. The US-Iran negotiations are occurring in the context of a broader American attempt to stabilize the Middle East while managing the Russia-Ukraine conflict simultaneously. North Korea's escalation in the Ukraine theater complicates the American strategic calculus in the Middle East, as Washington must now assess whether Iranian and North Korean cooperation with Russia represents a coordinated multi-front challenge to the American security architecture, rather than separate regional issues amenable to separate regional deals. If that assessment is correct, if the North Korean deployment reflects a coordinated Eurasian strategic alignment that connects the Russia-Ukraine conflict, the US-Iran confrontation, and the China-Taiwan tension into a single strategic challenge, then the Iran deal optimism that drove the S&P 500 record may be pricing a diplomatic resolution of a single piece of a larger structurally connected strategic challenge. Treasury Secretary Bessent's announcement that the US and Iran are close to a Hormuz deal is, in isolation, genuinely positive news. A reopened Hormuz, lower oil prices, reduced inflationary pressure, falling rate hike expectations, all of these are real and near-term positive developments for financial markets. But this series documented in the ninth video, the video examining the first Iran ceasefire, the specific historical pattern of deal euphoria, the consistent tendency of markets to overprice the durability of geopolitical agreements struck under time pressure without resolved underlying interests in the form of framework deals rather than comprehensive treaties. The current Hormuz deal optimism is the third iteration of this dynamic in this series alone. The June 23rd move produced deal euphoria that lasted 6 days before weekend clashes resumed. The subsequent diplomatic activity produced the current optimism that has driven the S&P to record highs. Each iteration of the deal euphoria pattern has been met by this channel with the same historical framework. Agreements that do not resolve the underlying structural conflict between Iranian and American strategic interests are intermissions, not resolutions. The North Korean deployment to Voronezh adds a structural dimension that makes the current deal euphoria particularly precarious. If Iranian strategic calculations are being coordinated with Russian and North Korean strategic calculations, if Tehran is assessing its negotiating position with Washington partly in the context of a broader Eurasian alignment that includes Moscow and Pyongyang, then the bilateral US-Iran framework within which Bessent is operating may be insufficient to capture the strategic dynamics actually driving Iranian behavior. This is not a prediction that the current deal will fail. It is an observation that the structural conditions surrounding it are more complex than the bilateral framework suggests, and that markets pricing the Hormuz deal as a resolution of the structural risk rather than as one more intermission may be repeating the valuation error of the previous two iterations of this same pattern. The S&P 500 at 50,6336 is driven primarily by a concentration of valuation in AI and technology adjacent companies whose earnings have been growing dramatically. The S&P 500 Q2 earnings growth of 37% year-over-year, concentrated in the Magnificent Seven and their ecosystem, provides genuine fundamental justification for equity market strength. This is the most important distinction between the current market record and the 2007 precedent. In October 2007, the earnings that justified the all-time high were partly illusory, financial sector earnings that had not yet reflected the write-downs on subprime exposure that would materialize over the following year. The current earnings are, to a significantly greater degree, real. The technology companies driving S&P 15, their performance are generating genuine revenue and profit growth from AI-related products and services. But the concentration of 35% of S&P 15 market capitalization in AI-adjacent companies creates a specific structural vulnerability that genuine earnings growth does not eliminate. Concentration risk, the vulnerability of an index to a single sector narrative's reversal, has historically produced the most severe and most rapid market corrections, precisely because the assets most concentrated in the driving narrative are simultaneously the most widely held and the most difficult to exit quickly. The technology concentration that drove the 1999 and 2000 Nasdaq peak was built on genuinely revolutionary technology. The internet was real, the productivity gains were real, the economic transformation was real. None of that prevented a 78% Nasdaq decline from March 2000 to October 2002, as the valuation premium built into the technology narrative compressed toward more sustainable levels. The AI revolution is equally real. The question is whether the valuation premium built into the current AI narrative, 45% of S&P 500 market cap, will prove sustainable, as the structural headwinds documented in this series, bond market at 5.2%, fiscal fragility, geopolitical escalation, create a kind of multiple compression that turns genuine earnings. The analytical synthesis of this week's data: S&P 500 record, North Korean deployment, Iran deal optimism, Besen statement, bond market at 5.2%, QCEOA employment data divergence from the previous video produces a specific and important picture. The short-term signals are almost uniformly positive, earnings strong, geopolitical tension apparently easing, rate hike probability declining, dollar stable, equity markets at records. The structural signals are almost uniformly concerning, bond vigilantes at the highest yields in decades, employment statistics diverging from administrative reality by 8 standard deviations. North Korea escalating military involvement in a European war. Iran deal optimism in its third iteration of a pattern that has twice proven temporary. AE concentration creating sector risk at historic levels. Fiscal trajectory compounding at higher interest rates than any point in recent American fiscal history. The gap between short-term positive signals and structural concerning signals is itself the signal. It is the gap that characterized every major pre-crisis market peak in the historical record, the gap between what the short-term pricing mechanism was optimizing for and what the structural trajectory was building toward. This gap does not produce a crisis on any predictable schedule. It can persist for months or years, as the 1036 to 1937 parallel demonstrates, with markets continuing to make new highs during the period when the structural conditions are assembling. The 2007 parallel shows the same pattern. The October record came after months of visible subprime stress, and the crisis did not arrive until a full year after the peak. What the gap does produce, historically, is the window of maximum repositioning opportunity, the period between when structural analysis identifies the divergence and when the short-term market mechanism finally prices it. The people who understood in 1936 that European rearmament was going to transform the global economic environment, and who positioned accordingly during the record-setting markets of that year, were in a very different position from those who waited for the market to confirm their analysis. The historical record on wealth preservation during periods when markets hit all-time highs while structural risks are accumulating produces specific and non-obvious lessons. The first lesson is that record markets during structural risk accumulation periods are not a reason to exit risk assets entirely. The 1936 to 1937 parallel shows that structural risks can take years to express themselves in prices, and the opportunity cost of exiting too early, missing the continued gains during the record-setting phase, is real and significant. The second lesson is that record markets during structural risk accumulation periods are also not a reason to increase risk exposure in the assets most vulnerable to the structural risks. The technology concentration in the current S&P 15, the 45% AI adjacent market cap, is precisely the kind of sector concentration that has historically produced the most severe corrections when the structural risks it has been ignoring finally express themselves in prices. The third lesson is that record markets create optimal conditions for diversifying into structural hedges, the assets that benefit from the structural risks rather than being vulnerable to them. Gold at record highs alongside equity markets at record highs is historically unusual. It typically occurs in periods of genuine structural monetary concern rather than simple risk-on sentiment. The current combination of equity records and gold records is itself a structural signal. It says the market is simultaneously pricing optimistic short-term scenarios and deeply concerning long-term monetary scenarios. Both cannot ultimately be correct. The fourth lesson is the one that runs through every video of this series. The historical record identifies the assets that preserve wealth through structural transitions, gold, energy, geographic diversification, real assets, and identifies them specifically because they were positioned before the structural risk was fully priced. At S&P 7036, with North Korean missiles in Voronezh and a bond market at 5.2%, the structural risks documented across 22 videos are present and accumulating. The record market is providing the window to address them. History says those windows close. Yesterday, S&P 500 at 7,736, all-time record. Confetti celebration. Also yesterday, North Korea deploys a missile unit to Voronezh, the first nuclear-armed state to provide active military support to one side of a European war since the Cold War ended. Markets price one of these developments. History will eventually price both. This series has spent 22 videos building the framework to read the gap between what markets price today and what history will record as having mattered. The bond market at 5.30%. Gold at $4,000. Employment data wrong by 8 standard deviations. A Fed chair who won't submit a dot plot. China selling treasuries. NATO fracturing along burden-sharing lines. Deal euphorias that have broken twice already. And now record markets alongside the most significant geopolitical escalation in Europe since Russia's initial invasion. History has seen this combination before. It does not tell you when it resolves, it tells you how it resolves, and the people who read the resolution coming, who positioned during the record-setting phase rather than waiting for the confirmation, were the ones whose wealth survived the transition that the records were obscuring. Subscribe, because this channel reads both numbers, the market record and